Good evening, everyone. It's just turned 6:30. Welcome to our VectorVest webcast. We have an audience, I think, from all over the world. Wherever you are, I hope all is well. And I'll do my best to be as focused as I can and not take up too much of your valuable time. Uh, I'm going to speak about the most conservative trading plan in the VectorVest toolbox. So first thing I have to do, folks, is to put up the VectorVest disclaimer. And although I'm qualified to give financial advice, I can't do so because I haven't sat down with you and done a long and a detailed fact find. I'm allowed to talk about shares that I own myself, but I have to make it very clear that although those shares are suitable for me, they may not be suitable for you. So that said, we can move on, and it's a great pleasure to be here. If somebody could just let me know the sound's okay. I've been on this thing half the day, it feels like, so I think we're okay. Adrian, you're right at the top of my list. I'm sure you're always at the top of lists. So thank you, Joanna. That's very kind of you. Okay. Sounds okay, and we can move on. The objective, folks, is to show you how to invest with confidence and consistently outperform the market in a few minutes a day. Now, we're not talking about day trading here. I'm not talking about buying the market at 9 o'clock and getting out with a profit at 10 past 9. We're talking about buying into a portfolio of stocks, which I'll define in the next few minutes, and then spending 10 minutes a day managing those stocks. Okay, so and the overall objective is to build wealth, and we're going to build wealth, and we've got three possibilities of how to go about doing that. And the first, and this may sound obvious, but capital growth. We want the share price to rise. That may seem obvious. 2, we want to get paid dividends, and we want to reinvest those dividends into the mix. And the third income stream, which is really difficult in the UK, is writing covered calls on the shares that you've got for an extra income stream. Now, at the retail level, which is us, the options market is very illiquid in the UK. I see Richard in the room, who's an options expert. Would you agree with that, Richard? Very difficult to actually write covered calls in the UK environment. My colleagues in the US who use exactly the same strategy in the US reckon that by conservatively and strategically writing calls on the shares they have within their portfolio, that they can add pretty much another dividend into this. In other words, they can make 3 to 5% a year by writing covered calls on a few occasions. Richard says no, he believes that the options market can be tackled in the UK. I haven't had any success with it myself. That's an interesting perspective. We'll have to discuss that at length, Richard. Certainly for my portfolio, I'm looking at number 1 and number 2 to be able to, in fact, grow the share price. Hopefully the shares will pay a dividend, and I can exercise the discipline not to blow it and put it back into the mix. Then if you do some of those compounding sums on Excel, you'll be absolutely amazed at how fast the thing grows if you reinvest the dividends. And I have a PhD in mathematics, and those compounding sums on Excel always amaze me. Einstein said it was one of the wonders of the world. Now, Richard does it Richard is just modest. He says that when he said no, he meant that he was not an expert. Richard's being modest, that's all. My experience is that the options market, maybe you can buy options, but to write options in the UK on stocks, and I have that from Joan Graham, who's our leader in Guildford, who in fact is very active in the options market. That's me, folks. Unfortunately, a week over 66. I can't believe it myself, but that is the truth of the matter. For those of you that are new to VectorVest, that photograph taken the Christmas before the portcullis came down on travel. So that would be what, Christmas 2019. And that photograph taken on the floor of the New York Stock Exchange, where I have a lot of really good friends, most of them South Africans. I spent 35 years of my life in South Africa. I went in 1981 to play rugby for 6 months, and I stayed 35 years. Along the way, before I went to South Africa, I've got a PhD in mechanical engineering, PhD in maths, first degrees in mechanical engineering, MSc in metallurgy. I put on my first trade in October 1982. I was working for De Beers in South Africa, and by April 1988, I was making much more trading the Johannesburg Stock Exchange and the commodities market than I was out of my salary. So in April 1988, I cut the corporate umbilical cord for good, and I've been trading on my own ever since. Worked at the institutional level quite a few times, a couple of years stints until I got really fed up with it and left on a couple of occasions. For example, on a day like today, where the whole world is waiting for the Fed tomorrow, if you work on an institutional floor, you got to sit there. There's nothing to do, but you just got to sit there. And you get that quite a few times a month, especially in the run up to non-farm payrolls. That'll be Friday week. 2 or 3 days prior to that, nothing happens, but you still got to be there. So I just couldn't handle it anymore. But for the last 10 years, I've been, in fact, helping retail traders. Started off in South Africa with VectorVest, and then more than that, about 8 years ago, VectorVest asked me to come and manage the UK business. And for 3 years, I commuted back and forward. And for the last 5 years, I've been permanently located back home and in Notting Hill in West London here. Very happy indeed. So what we're going to try and talk about is the VectorVest system of analyzing shares. And folks, during the little talk, I use the word share and stock interchangeably. They mean the same thing to me. We're then going to talk about something which is quite controversial, which is market timing. Many people believe that this can't be done, but at VectorVest, we believe that there's a good time to be in the market and an awful time to be in the market. I've illustrated that myself over the last 18 months. I do some short-term trading, which I'm not talking about today, in the American market via a local London spread betting company. And last year, from March, April, I printed money. I couldn't go wrong. And from March this year, I've struggled. I've struggled. I haven't lost any money, but I haven't made any decent money either. And that's largely because the overall market has been flat since March. Very difficult to make some money in the US market in that type of environment. So we at VectorVest, we believe that the most important thing is being in sync with the overall market. And then what I'm going to try and do is to wind it all up and put it together in a safe and robust, worry-free investing strategy. Now, those of you that are new to it, folks, don't be switching off because you think this is too conservative for you. As I'll show a little bit later, from April last year, which is about, 15 months ago, the worry-free strategy is up 55%. And that's by doing nothing. I know an awful lot of day traders. I know an awful lot of swing traders who sit in front of screens for 8 hours a day. I don't know many of them that have made 55%. And in fact, if you look at IG stats, you'll see that 75 to 80% of people who go anywhere near it lose money. So you really need to know what you're doing when you go into that noise, the day-to-day noise of the market. You've got to be quite good in there because you're battling against one, randomness. Elon Musk tweets some news item. That chap at Imperial College says something about COVID. He worried me today, that fellow, because he says it's all going to go away by October, and pretty much everything he said in the past has gone wrong. So that worried me. First thing you've got to work against is one, randomness. Two, you've got a fellow on the other side of your trade in an Italian suit who's been around the block for a very long time. And the third thing, of course, is the algos that are programmed to, in fact, take advantage of all of your emotional biases. So going into the noise is difficult. I'm not saying it can't be beaten at all, but I'm saying you've got to be good in there. And if you don't believe me, just have a go. Okay, just have a go. In the strategy I'm going to talk about tonight, in our worry-free strategy, we're staying well out of that noise and doing our best to put a long-term trend behind us. And for most people, that's a relatively easy way to make some money. And if I were managing your money, and I've managed a lot of money in the past for high net worth individuals, mostly in Cape Town, I would put 70 to 80% of it into this plan. And with the other 20 to 30%, then I would have a go at some more aggressive trading. But those of you that follow me on Monday afternoon will know that the shares that I have in my Monday afternoon portfolio that are worry-free type shares have done exceptionally well. And my two aggressive stocks, I'm struggling in, two gold mining stocks. So I'm very hopeful of both. But the worry-free stocks just keep slugging away and give you a very, very quiet and pleasant life. And we have a lovely lady who runs our London group called Susan Thornborough. And Susan only uses the worry-free strategy, and as I'll explain a little bit later, she uses a more conservative worry-free strategy than I do. And that's why we're both about the same age. She looks 30 and I look 80. That's the reason. When you get anywhere near that noise, it can be quite difficult. Okay. As I say, if you don't believe me, just have a go. So the VectorVest system for analyzing stocks. Everybody listening, I'm quite sure, and we've got a full room from all over the world. We've even got Carwyn from Wales. Hello, Carwyn. Everybody here is into property, either your own property or you've got buy-to-lets and all that sort of stuff. The three most important words in property are location, location, location. Well, the three most important words in the stock market are earnings, inflation in the general economy, and interest rates. Now, if you've been reading anything about markets over the last 2 or 3 months, the inflation is coming. And I saw today, or was it yesterday, that Germany recorded the highest inflation number, CPI number, since the 80s. You saw that big number out of the US last week, double what was expected. The central bankers are hanging on to this idea that this inflation is transitory, is the word that's come out. In other words, it's temporary and it's caused by supply problems due to the COVID shutdowns. The rhetoric at the Fed in particular would seem to be less certain of that than it was several weeks ago. So if inflation arrives, invariably interest rates go up And the very smell of interest rates going up in 2023, 2 years hence, caused the market to sell off some weeks ago. So based on this, Dr. Bart Toledo, who's the founder of VectorVest, who would, I think, loosely describe himself as a fundamental analyst, whereas I would describe myself more of a technical analyst. He's put together a model that calculates a value for every share in the market every single day. And so that every investor can work out what's a share really worth. Using Dr. Toledo's algorithm, we can also get a number for how safe the earnings stream is. And then we can put a technical number to the trend of the share price. Is it going up? Is it going nowhere? Is it falling? These two are fundamental measures of the company, and this is a technical measure of the company. And my definition of fundamental analysis, ladies and gentlemen, is it's the search for the true value of a share. And my definition of technical analysis is it's the study of trends and turning points. And what weaves itself through the VectorVest approach, whether it's long-term trading or position trading, such as I'm speaking about today, is that we want to try and get the best of both worlds. We want to try and find stocks with really great fundamentals that are in fact moving our way. So no being a hero and buying a stock that's falling. I'm not saying that you don't buy a pullback, folks, in a share that's trending strongly, but we don't want to buy shares that are trending down. The best of both worlds, the best of fundamental analysis, the best of technical analysis. And because this is a hands-off conservative strategy, this evening I'm going to focus on the safety and the predictability of the earnings stream. We don't want surprises. If this were a momentum trading evening, then I would be focusing on earnings growth, strong earnings growth. But as you'll see a little bit later on, I want to try and get a foot in both camps to find shares that are growing earnings reasonably strongly so we get that capital growth. And very importantly, safely, so that, as my old rugby coach used to say, the ball does the work. So let's skip to our first proprietary VectorVest metric, relative value. And those of you that read my essay at the weekend, which comes to all VectorVest subscribers, I wrote about relative value, in fact, this morning. Relative value, as the slide says, is an indicator of the long-term price appreciation. Now, for a long term, 3 years. Okay. So it works out and predicts the share price rise in relation to what a corporate bond will pay in the same 3 years. Now, this is quite a calculation because to do that, we forecast the profits, earnings of all of the companies in the London stock market for the next 3 years. So we work out how much it will make next year, the year after that, and the year after that. Now we make the following assumption. We assume that those earnings will be discounted into the price at some time within that window, not when. And we work out what the price will be. We take that projected price and we subtract the price today to get the upside, and we divide the upside by what a corporate bond will pay in that same period. Now, if the relative value is less than 1, that's not good, folks, because you would be, in fact, buying into a company where the probabilities favor the share price rising less than what a corporate bond will pay. Now, those of you that are familiar with the pecking order of who gets paid and when will know that the corporate bondholders are a long way in front of the common shareholders in terms of the payout, and the corporate bondholders, now subject to correction, are only second to HMRC. So that doesn't make a great deal of sense from a business point of view. If the relative value is greater than 1, that's not bad. We're outperforming what a corporate bond will pay. And if the relative value is greater than 1.25, ladies and gentlemen, that means that your share has a high probability of outperforming a corporate bond by 25%. Now, we've done a lot of research on relative value, and one of our subscribers in particular, a young man called Mark Cowan from our Guildford group, has in fact looked at the worry-free methodology worldwide, and he's concluded, and I concur, that if a share has a relative value of greater than 1.25, that greatly adds to the probability of us, in fact, achieving that capital growth that I spoke about. As you can see, relative value made up of earnings growth. So our first parameter that I'm going to ask for to find a worry-free stock is that it should have a relative value of greater than 1.25. If that's the case, over that window of 3 years, the share price should rise significantly and help us get wealthy. Now, the second number is relative safety. And as I said earlier, that's of prime importance in our worry-free trading plan. Not so important in a short-term momentum plan. And as the slide says, relative safety measures the consistency and the predictability of the financial performance. So what Dr. Lado's algorithm does is that it looks at the financial data going back 5 or 6 years that we buy from Thomson Reuters. It looks at the balance sheet, the income statement, the cash flow statement. It looks at sales growth, obviously. It looks at margins. Dr. Toledo loves his margins if you read his book, Stock Strategies and Common Sense. It looks at all those financial ratios. It sucks those all in and spits out one number on a scale between 0 and 2, like everything else on VectorVest. Now, less than 1 is not good. If the relative safety is less than 1, it means that the financial results have been patchy. They've been up and down, good times, bad times. Dropped the ball along the way. Now, that stock could be wonderful for a momentum trading strategy. Okay, it could have 6 months moves in it that you can capture 30 or 40% gains plus. But for a hands-off worry-free strategy, not good. If the share has a relative value of greater than 1, that's not bad. It's getting fair. And for this strategy, guys, I like to see the relative safety up around the 1.3. And that indicates that this company has got a safe track record of making money. All the financial ratios are getting better. Now, a high relative safety does not mean that the company can not drop the ball. It can drop the ball. It's just not going to happen all that often. Now, over the last year, was it a year and a half, we've had one high RS company that's dropped the ball on me, certainly, and that was Avon. I believe it's now called Avon Protection. We discussed it on Monday afternoon. It may be coming right again. Nevertheless, they dropped the ball in that they make masks, among other things. They make masks for the American military, and there was some form of technical problem with the masks that caused their earnings flow to fall through the floor. Hopefully they can get it right. It was a great stock. We had a great run in it. So already I've got two numbers for my worry-free strategy. The first number is relative value. In other words, the RV greater than 1.25. That means that we've found a company where the earnings growth is good. Maybe not great, but good. Good enough to cause the share price to rise significantly. And very importantly, safely. So these are hard to find on the UK market. And there's not that many of them, folks. They're what I call sweet spot stocks. Stocks that have got the ability to grow their earnings reasonably strongly, but very importantly, safely. So those are the two main criteria for worry-free stocks. So let's move on. Relative timing on VectorVest measures the short-term price trend on a scale between 0 and 2. Vitally important in short-term momentum trading, not that important for our discussion this evening. And then what Dr. Bartolino did is that he put together RV, RS, and RT into a single comprehensive indicator, which he calls the master indicator. And as a default, all of the shares on the London market are sorted by descending VST. And if you're a momentum trader, that's a great place to look. This evening, when we get into looking for these stocks, I'm in fact going to sort all of the shares by relative safety to bring the safest shares to the top of the pile. Again, those of you that class yourselves as aggressive investors, don't switch off, because this has produced a tremendous performance over the last few years. We put a stop loss to every share in the market every single day, which is loosely calculated around a 13-week moving average of the closing price, which is adjusted for RV and RS. If RV and RS are high, and they will be with a worry-free stock, then we widen the stop loss. We give the share more room to move. And that's vitally important, folks, because the best ones tend to pull back before they move. And if you sit and look at your charts, you'll see frequently that the biggest moves are preceded by a spike backwards. And that's largely because of stop running, where somebody wants to get his best client in or himself in at a good price. Because when your stop loss fires, that's a source of liquidity for somebody else. And out at our Oxford group some years ago, well, a couple of years ago, I had a grown man in tears because he was trading in JD Sports, and JD Sports went up by about 30% in one big move. Prior to going up, it spiked back and ran a 20-day low. Now, the 20-day low was quite a famous place to putting stops, and he had a stop down below the last major low. Market went right back, and of course, that generated a tsunami of liquidity where the institutional traders could fill their boots and get their best clients filled at a really, really good price. And I know exactly how to do it because I did it myself for years for good clients. If you fill your client at the high of the day or the high of the week, well, you'll get a ticking off that would make a Royal Marine Sergeant blush. So you don't want to do that too often. If you do it too often, well, you won't have any clients left. The VectorVest stop loss is placed out of the traffic. Doesn't stop that happening, but it reduces the possibility of that happening. Those of you that have been at this for a while will know that stop losses can be a real pain, and sometimes they get you out. Happened to me. They get you out at where you should be buying in, but nevertheless they do protect you from a catastrophic disaster. And those catastrophic disasters cause two problems. One, you lose money, a lot of money, and that can set back the whole year. And more importantly, it absolutely flushes away your trading self-esteem. And that's a very important item. The market can certainly knock you. And I'm quite sure that there's quite a few people listening that have been knocked by the market, and you need a huge amount of resilience to bounce back from that. So stop loss placement is absolutely key. The VectorVest stop loss does its best to place the stop well out of the traffic. We put a buy, sell, or hold to every share in the market every single day. And that can be used for timing the market. And those of you that are established VectorVest customers will know that we also calculate the buy-sell ratio, which is a measure of the breadth of the market, which is exceptionally useful. So that's the system, folks. And I just want to go into VectorVest and have a look. If we go into VectorVest UK, there's the home page. And I'm going to explain this in some detail in a moment. If we go to viewers, and I want to go to the stock viewer. Come on, internet, don't let me down. And what we look at? We'll look at Lion Trust. We've had a cracking run in Lion Trust. At least I've had a cracking run in it. It's trading at 2015. VectorVest believes it's worth 21. So it's getting close to being fully valued in the short term. It was down 10 pence yesterday on a really bad day for the overall market. Chinese problems. Now the RV, which measures the share price appreciation potential in relation to a bond, corporate bond, is at 1.5. Now that is just an outstanding number. What does that mean? And I wrote about this today, in fact, in the essay. It means that although this share is looking pretty fully valued now, if the share price stays at £20 and the earnings come in as we anticipate, then at some time over the next 3 years, that's going to be significantly undervalued. So it looks, based on these numbers, that there's still an awful lot left in Lion Trust Asset Management. Relative safety is 1.45. On the scale between 0 and 2, that's excellent. So this share would qualify, based on RV and RS, as a worry-free stock. RT is 1.53, which means it's trending up strongly. And when we put those together into the master indicator, it's got a VST of 1.49, which is the fourth highest in the pack. It's on a buy recommendation. There's the stop loss at 17.39. Now, I didn't have time to talk about this. The VectorVest subscribers will know how fond I am of the comfort index. And the comfort index is sitting at 1.39. New people, the comfort index measures the long-term trend of the share price, and RT measures the short-term trend of the share price, and both are saying yes here. GRT, again, I didn't get time to talk about that, but GRT is the percentage annualized earnings growth next year. That's our best shot at it. And that is a huge 25%. And that's a big part, ladies and gentlemen, of RV. Now, to the right, we've got our best shot going forward at earnings yield, PE, and dividends. If I pull up the chart, that's the chart. And that's what the share has done recently. We had a frustrating period in the share. It went nowhere, and the whole London market went nowhere for months. I bought into the share. I hope most of the VectorVest subscribers bought into the share. Some are down around here after the sell-off. This is the COVID sell-off. You can see the shares left the February high well in its wake. It clipped its stop loss just here, and those of you that are subscribers will remember one Monday afternoon we scratched our head in our weekly Q&A as to what we were going to do there. If you remember that, and I decided to give it another day, and away she went. Uh, that is starting to look very good. We're trading above the 21 day. I use three moving averages, 21, 55, and 89. And from here, from 14, it really soared when all the moving averages came together. So holding this from way back here, I'll tell you, it's just there. That was the signal. I actually got in a bit earlier than that. And I'll explain these red and green triangles in a second. Those are our market timing calls. So that's Lion Trust, folks, and that's been a great run. Watches the Switzerland's an interesting stock. Many of our members have done really, really well in this, although it's not a worry-free stock because it's undervalued. It's trading, RV is 1.52, which is great. RS is 1.11, which is on the low side for a worry-free stock. A lot of people buying flashy watches. RT is 1.71. VST is 1.48. It's on a buy. That's the stop. CI is an incredible 1.94 and should grow earnings at 36% next year. That would be a great momentum trade where RS is not that important. If we have a look at this, and as you can see, there's the trend that's been in place, and there are the moving averages coming together, and away she just kept on going the whole way up the page. As you can see, being on a buy recommendation the whole way up here. I haven't got that because it didn't fit into my worry-free portfolio. The RS was on the low side. So I mentioned Susan Thornburgh a second ago, and Susan at our national user groups and will show you how she actually finds stocks just using the stock viewer itself. But later in the presentation, we'll use Unisearch to automatically find these stocks. And in Unisearch, we can actually write a little bit of code, nothing to it. Even I can do it. To find stocks with an RV of greater than 1.25, with a high relative safety, with a reasonable liquidity that are on buy or hold recommendations. So we'll find those automatically. I think Joanna from our Oxford group mentioned that there's an awful lot of investment trusts showing up at the moment, and that's for sure. The investment trusts have done nothing in nearly a generation, Joanna, and they're coming now, and that's a very, very good sign for the London market. A very good sign for the London market. I've noted over the last 25, 30 years that investment trusts come right when the general market is just about to move big time. So that's a very good sign for the market. I own a few investment trusts. I own in a BlackRock World Mining, which is a mining commodity investment trust that was suggested to us by Rob from Oxford. But I have quite a few conservative investment trusts that I inherited from my father. I've never touched them. I'm scared of the old man shouting at me for the grave. They are all very conservative, high dividend. You know, those investment trusts that have paid a dividend, increased their dividend for the last 50 years. Merchants, I think it's called, and one's called the City of London Investment Trust that he used to swear by. They've just been sitting there. I've never looked at them. So I'll show you later on how to filter out the investment trusts if you wish, okay, and just look at companies. Let me move on a little bit. In our worry-free strategy, I want to find shares that are growing earnings reasonably strongly, but very importantly, safely, that are rising on a buy or a hold recommendation. In other words, they're either trending up or they're slugging sideways. Markets don't rise in straight lines, folks. They go up and they pull back a bit and then they go again. that they run a bit. The short-term players take their money, they pull back a little bit, and then people buy back in again. So we're looking for shares that can grow their earnings reasonably strongly and safely, that are either rising or going sideways. And we want to buy the darn things when the general market is rising. Now, the mantra is buying rising stocks with great fundamentals in rising markets. And for another day, although I'm no great expert in shorting stocks, I've got a lot of experience in shorting the index, but I haven't got a great deal of experience in shorting individual stocks. We would sell falling stocks in falling markets. Selling stocks short, making profit when the market is falling, can be done easily in the UK, but you're going to have to open up a CFD account or a spread betting account to do that. Rarely, unless you've got a huge portfolio, will your broker run around and find the stock for you to short. At least that's my experience. If you do open up a spread betting and a CFD account, there is 5-to-1 leverage, and 5-to-1 leverage is wonderful if you've got the discipline to respect it. If you haven't got the discipline to respect it, it's suicide. So just be careful with leverage. Also, folks, the short side of the market, you've got to be better. You've really got to be better at your game. You're competing against a completely different player. And very few people believe me on that until they have a go themselves. Okay, so onto your buying a share at 10, selling at 15, and congratulating yourself. When you're doing that consistently, then just leave the short selling to somebody else. I'm 66. I'm probably getting old and conservative. You'll have to bear with me. But I've been at this for nearly 40 years, and there are old traders and there are bold traders. But I know from experience that there are no old bold traders. So just be careful. Dr. DeLito says the direction's the key to making money in any market. Being the wrong side of the market is the worst thing that can happen to an investor. It doesn't have to happen to you. My father told me the story that in 1979, the London market made a high. It's not true. 1969, the London market made a high. It took 21 years for the market to break that high in real money. It didn't break that high until 1990. And those of you that have been about in that period will remember that the market bottomed out. From 69, it bottomed out in 81. So what was that? 12-year bear market. From 81 to 90, it rose and rose strongly, but it took from 81 to 90 to break the 69 high in real loot. And then, of course, we had a huge move in the 90s, an unbelievable move in the 90s. And unfortunately, if you look at the FTSE 100 now, and you look at it on the 1st of January 2000, it's only a couple of hundred points away from that. But along the way, there's been some great moves. We had a move down to 2003. We had a huge move up into 2007. Some of you will remember the crisis. And since 2009, March the 9th, 2009, we've been in a bull market, apart from the swoon that was caused by the euro crisis, and then, of course, the swoon that was caused last year by COVID. So there's been some great moves in the London market since 2000, but the overall market has been flat. And as the corporate fellows will show you, that if you took the dividends and you've added the dividends, you've done okay. But if you'd traded some long-term moves, you would have done much, much, much better. And we're taught to ignore market direction, And the mantra, of course, that you'll hear from your financial advisor is that it's time in the market, not timing the market. And maybe that's true if you've got a £1 billion portfolio, but I haven't. And if you've got a few £1,000,000 in your portfolio or less, you can get in and out by pressing the button. And when I get a couple of billion in my portfolio, I'll worry about that then. That's my metaphor that many of you will have seen before, where on these contraptions it takes many, many minutes to get up there, and then it falls very quickly. So markets do the same thing. So let's look at VectorVest and how we actually cover this in VectorVest. So I want to go to the front page of VectorVest. On the front page of VectorVest, this is last night's data. VectorVest UK is an end-of-day program. Very, very difficult to be a short-term intraday trader in the UK market with spreads, with brokerage, and the 0.5% stamp duty. And a lot of the strategies that work well in VectorVest US just don't hack it across here at all because of that 0.5% headwind. And that $9.95 that we account for brokerage, that's free in the US. I asked a US broker how they could do it for free, and he turned his head and didn't answer me. I'm sure you've heard the stories of what how they make their money on the side by selling lists and front-running orders. So nothing is free at the end of the day. For the purposes of our discussion this evening, the two most important words on VectorVest are these two: up and up. And the first word refers to the short-term trend of the entire London market. And the second word refers to the underlying trend of the entire London market. And today, or at least last night, the short-term trend is up and the underlying trend is up. Now, to the right-hand side, we see this thing called a call. And the call is the longest term measure of the trend on VectorVest. As you can see down here, it was in green, confirmed up. And on the 19th of July, the day I turned 66, the call turned from a confirmed up to a confirmed down. Now, that confirmed up had been in place since the 11th of November last year. So these don't change that often. At the moment, the underlying trend is up. If the underlying trend remains up and the London market trades for 2 5-day periods up, then that confirmed down will change to confirmed up. So a little confusing tonight. The underlying trend is up, but the call, which needs 2 weeks price confirmation, has not turned. Similarly, for the call down, the underlying trend, data's just come in early tonight, the underlying trend turns to down, and the market should trade down for 2 5-day periods in a row. The call is what we use for our worry-free investing. And at the moment, we've still got a confirmed down in place, so we wouldn't be buying any stocks. And the data has just come in, and clearly with all the stuff that I've got running, it's struggling to keep that under control. This is the 28th. When this confirmed down turns to a confirmed up, then we have permission to buy stocks. Now, the traffic light measures the strength and the momentum of the short-term trend. And this definition of how we buy stocks was in fact put together by Carwin, who I've just spoken to some years back. And Carwin come up with the idea, which I've stuck to ever since, that to get permission to buy stocks, we must have a confirmed up in place, and that the pointer should be fully in the green. In other words, the short-term trend and this longest term measure of the trend should be saying the same thing. And it looks as if we're nearly there. So we'll have a look at that in a second. This data's come in, and I think I've just got so much open. I'm streaming on YouTube as well, folks, for my sins. I've just got so much open, it's struggling here. Is the sound okay out there? If somebody could tell me, sometimes if the internet starts to struggle, the sound deteriorates. I hope it's okay. Thank you, Andy. That's very, very kind. Ladies and gentlemen, we still have to wait for a confirmed up. It could pitch up today because these results, today's data will be in any second. Okay. If I go to timing now, I can show you how this is actually made up. And this, as you can see, I've got my fibs on here. But this is the VectorVest composite of the UK. And this is what we base our market timing signals on. This is an equally weighted index of all of the shares that we follow on the London stock market, some 2,200 shares. Now, down on this little drop down, we have all the VectorVest market timing systems. From long term, which is our confirmed calls. Remember, for a confirmed call, the underlying trend must be up and it must be confirmed by 2 weeks price action. As of last night, which is the only data I've got until the upload is done, as of last night, the underlying trend was up, but it hadn't been confirmed by 2 weeks price action. So we're still in a confirmed down situation. The primary wave is the shortest measure of the trend. I think that if you were a short-term spread better, it would be useful. The DEW is for medium-term swing traders. I use it a lot for swing trading. And these are also short-term trading systems. And in the essays that I do and in the Monday afternoon presentations that I do, I pretty much make use of the confirmed calls and the DEW and the green light. So if I click here, it now puts those red and green triangles onto the chart. And as you can see, the last one was here on the 19th of July. That was a confirmed down. So that confirmed down is still in place as of today. Now, most confirmed downs, ladies and gentlemen, come to nothing. But at the minute, we don't know, is this going to be one like November, or is it going to be one like last February? Here in November, well, when it went to down on the 27th of October, that was quite a scary time because we're moving into that second lockdown period. And then the Pfizer, I remember that Monday afternoon in our Q&A when that Pfizer announcement came out, and away we went again. Many argue that this sell-off that we had last week was caused by, was the week before, was caused by a great deal of worry worldwide on the Delta variant. And that seems to have gone away a little bit this week. I presented some stats on Monday afternoon at a Q&A that I got from a friend of mine that painted a very positive picture about what's going on in COVID. Nevertheless, people are still dying from it, and two very good friends of mine died from it last weekend in South Africa. They were unvaccinated. One guy that I played rugby with for years, and a friend of mine who's a stockbroker, his wife, both incredibly fit people, not overweight, anything, but they weren't vaccinated. So what's the plan? Well, the plan is, ladies and gentlemen, that when we get a confirmed up, and I assure you that confirmed up wasn't easy to take. And I assure you in November, that confirmed up wasn't easy to take either, because we were going into another huge lockdown, and the world seemed to be falling apart. The news was awful, and it's always the same. If you get nothing out of this webcast, and I know the VectorVest regulars will be glazing over now, but just write the following down. When it's time to buy, you won't want to. Simple as that. And when it's time to sell, you similarly won't want to. Now, with our worry-free strategy, when there's a confirmed up, which there isn't at the moment, when there's a confirmed up, and that confirmed up is complemented by the traffic light on the front page of VectorVest with a little pointer in the green telling us that the long-term trend is up and the short-term trend is up. Both little boats are going in the one direction. A little boat and a big boat going in the one direction. We want to buy 10 stocks that have got the ability to grow earnings strongly, RV greater than 1.25, RS greater than 1.3, with reasonable liquidity. And I'll define that for us in our uni search in a second. When there is a confirmed up, we want to be fully invested. And if it takes you, let's say you buy 2 a day, it takes you a week to becoming fully invested, that's great. As you can see, the confirmed calls ignore this noise. All right. And I assure you folks that that noise looks absolutely easy in hindsight. Just have a crack in it. I assure you that it's much, much more difficult on the hard right edge than it is in hindsight. Few people believe me on that until they have a go. So when we've got a confirmed up, we want to get ourselves fully invested in 10 to 15 stocks with high RV, high RS. When you get a confirmed down, ladies and gentlemen, we want to do nothing. But not buy any more. So let's say if you get a confirmed down and your granny dies and leaves you £1 million, well, you would keep it in cash because you can't buy. The rule is that when we've got a confirmed down, you sit on your cash. In a confirmed down, there's much higher a probability that you will get stopped out of some of your high RS shares. In other words, they fall below the VectorVest stop loss. If you do get stopped out, you build a cash position. So let's say in this little pullback, we got stopped out of 2 stocks, which didn't happen, I may add. We got stopped out of 2 stocks, you would now be 8/10 in stocks and 2/10 in cash. When the next confirmed up arrives, go back to being fully invested again. Now, in this pullback, I didn't get stopped out of anything. In this pullback so far, I haven't been stopped out of anything. In fact, the high RS stocks, in fact, have done well over the last day or two. So most of the confirmed downs come to nothing, or maybe you'll get stopped out of 1 stock or 2 stocks. In that case, you build a cash position, and then you get back in when there's the next confirmed up. And I assure you that I've been doing this now for weeks, and I was saying to everybody that as sure as day follows night, we're going to get a confirmed down soon. Markets breathe in, they breathe out like individuals. Now, I didn't get stopped out of anything here so far, not stopped out of anything here, but last February got stopped out of the lot. Just there. If we go back to the last proper summer that we had, this is very typical of the UK summer, Northern Hemisphere summer, where the market goes absolutely nowhere and you get whipped. And in this one, which happened in August 2019, we were stopped out of 2 stocks. So in 2019, ladies and gentlemen, the worry-free strategy was stopped out of 2 stocks the whole year. And then in February of March of 2020, we get stopped out of the whole blessed lot. And that's why I say, on this one, we don't know, is it one of these or one of this noise? My stomach tells me that it's noise for the time being, but I'm not trading my stomach, I'm trading confirmed calls. So if we look at this, we can see that the market was up today, but the market, although the underlying trend is up, those of you that are VectorVest customers, the underlying trend is based on this indicator called the MTI. And if the MTI is above 1, that means the underlying trend is up. So the underlying trend is up, but it still hasn't, in fact, charted 2 5-day periods of rising prices. And when that arrives, then we'll get a little green arrow here and the sell-off is over. So most of them come to nothing. And I must admit, and we have an expert in divergences also from our Oxford group, Steve Goff, and both he and I concurred that this pattern, which I'll spare you, looks quite positive for the London market. So there's many things that the London market is cheap in terms of how many years it takes to pay for stocks, PE ratio. It's been my observation over the last 40 years that investment trusts tend to front run the overall market. And from a technical perspective, this divergence pattern looks quite good to me. Nevertheless, we've got a confirmed down in place, and the rules are don't buy stocks. So if your granny doesn't quite give you £1 million, let's say she gives you £250,000, Richard, in her will, then sit on that until you get it confirmed up. Okay. I hope that I didn't have much time to explain that, but the front page of VectorVest, folks, to work out is the market rising or falling, you need to look at nothing more than this. And from that's the American market. I wondered why I was confused. From the 19th of July, okay, from the 19th of July, this changed to down and just there, and it's still down. So a reason that the short-term trend is good. So if this were to change tomorrow and the traffic light is here, then we'd be well away. This still hasn't updated for me for some reason. I don't know why. I don't know why. The internet or something. So I hope that I explained the market timing reasonably well. It's not complicated. And all you really need to do is to watch the front page on your phone, and that'll tell you whether you're in a confirmed up or a confirmed down. Have a quick gander at the traffic light. If you've got a confirmed up and the traffic light, the little pointer's in the green, then that's great. So how do we put this together? Well, you can do it the way Susan Thornberry does it, and I frequently have Susan demonstrate that on our Monday afternoon webcasts. But we can automate it by using Unisearch. And the crux of the matter, folks, is finding the very, very best stocks. Those stocks that have got that ability to grow earnings strongly and safely. There's not that many of them. Now, clearly, this needs to be tested. And I tested and I tested and I tested. I haven't done much back testing recently because I've been testing it going forward with my own money, and I've had a great run with it. We've tested it a lot in the past, and I'll show you a 20-year test that I did some years ago. The key is relative safety, and we want that relative safety certainly to be above 1.25. 1.3 would be better, but 1.25 at least. We want earnings to be strong and that to be manifested by a relative value of greater than equal to 1.25. And that is the little uni search that I've come up with. There's not much to it. Not much to. We have an expert in uni search from our Oxford group, Mark Crittenden, who spoke to everybody and blew everybody away at our national user group last Wednesday night. He really can make that thing sing. This is a very simple search. It looks for shares that are above 50 pence, 50p. That's volume, and there's no doubt if you've got a £5 million portfolio, you're going to have to up that a little bit. That's on the low side. Now, that little double R means not. And I haven't looked at companies on AIM. I've just looked at the main market. I've got lots of people who run really big portfolios, and they've actually just put in the FTSE 350 here. So they only have FTSE 350 companies which have suitable liquidity for their portfolios, and the spreads are tight. Relative value greater than 1.25, and the stock should not be on a sell by inference, either on a buy or hold. And the shares that come out of that, folks, I want to sort by relative safety. Bring the safest ones to the top of the pile. We're going to use our confirm calls to get in, and remember the entry signal is confirmed up, which we haven't got at the moment, and the traffic light in the green. That's what the market has done. That's the overall market, and that's since last April, folks. That's what it's done, and that was I'm going to run this now, but that was the end of June. So let me go out of this, okay, and go into VectorVest UK, and go to Unisearch, and I've got the search here. I teach the search as a part of my ISA Millionaire course, so I have it in there. On your programs, it's going to be under retirement. And that's the same search, maybe in a different order. Easy to write these things in. And that's today's date. And if I run the search, it in fact gives us these companies: 3i, Lion Trust, Barrett, Persimmons, Vistry, Games Workshop, Scottish Mortgage, Crichton's, Computer Centre. I'm holding a lot of these myself. Kenos, I'm holding. If I were to go back to last April, there's an easy way of doing that. Okay, 20. Yep. It was in April. And it marks the confirmed calls on here for us. So on the 27th of April, that was the confirmed up after the COVID sell-off. I, in fact, started to take positions based on some of the short-term trading plans earlier than that. If the VectorVest subscribers remember, it was one of my better times, in fact. I got stuck in very quickly. If we run that search, Avon Rubber at that stage was right at the top of the pack. As you can see, it had a relative safety of 1.51. Unfortunately, it dropped the ball with its gas masks. If I were to test the top 10, and this is just a pure linear search, we can see that that portfolio is now up 63%, folks. Games Workshop has been great, and I don't know what the market needs Games Workshop yesterday reported earnings at 69% up on last year. And the share price fell by 5%. In this market, if they don't outperform, then people get upset, that's for sure. So I thought the numbers were absolutely marvelous, and I thought that the rollout of the product in China to come looks exceptionally exciting. As you can see, there's Avon down 3% on the year, but that is a 50% annualized return, 63% in the last 15 months. How many day traders have made that? And that was done by just sitting, buying shares that can grow their earnings reasonably strongly, safely, when the general market is rising. Now, it's not going to do a 50% annualized return every year, folks. Clearly, off the COVID lows was a special time. So if we now go to the last confirmed up, which was in November, just here. Just remember, in that sell-off in November, we weren't stopped out of anything. The only share we were stopped out of, in fact, during this period was Avon Rubber. And that's what came out of it on the 11th. And again, I'm holding a lot of these. I'm holding Lion Trust, I'm holding Pershing Square, CompuCenter, Cranswick, one of my favorite shares, and a few investment trusts in here, Joanna, as you can see. I'll show you how to get rid of those in a second. If you wish, maybe have one investment trust. We do a quick test. We can see that that portfolio has virtually doubled the market. It's up 25%, the market's up 15%, not quite doubled. And that's a 35% annualized return. And that's not off a major low either. That's not off a major low. The investment trusts have had an outstanding run. They really have. There's always a controversy about investment trusts because VectorVest value an investment trust as if it's a company because it reports earnings, and some fundamental analysts do not agree with that. There's always a little bit of controversy about that. If you want to just look at individual companies, if you go to time of search, stocks, filter by industry group is not selected industry groups, go down to F, financial trusts, and that in fact is a line, a very simple line of code that gets rid of the investment trusts. And there you are. That's the investment trust that we've got on that day. If we quick test the top 10, it hasn't reduced the performance that much, a couple of percent. 19%, that's up. The market's up 14.86. The investment trusts have a really cracking run. If we have a look at what's happening now without the investment trusts, and remember, we haven't got it confirmed up yet. If the market keeps doing, that's Lion Trust, Barrett, Persimmons, Vistry. Now, Susan Thornborough uses a more conservative approach than I, because she only buys into stocks with an extra line of code. And she actually looks for the price to be less than the value. As long as the RV is above 1.25, I'm happy to buy into a stock that's trading above its VectorVest valuation. Because my experience is they just keep on going, and I've justified that in the essay this weekend. Susan is happier with a more conservative approach, and my word, she trades well. So if we put another line here, stocks, price, is less than equal to stocks, capital appreciation, VectorVest value. And that will in fact, that's a search that hasn't got any investment trusts if you're not comfortable with investment trusts. And it also looks, and Susan would be happy with that, because now she's only buying into shares that are trading below the VectorVest valuation. I use the search that I've just talked about a second ago. I don't put in this level. Sometimes you pay for that. If we run that search, that's what we get. And we got 3i, Lion Trust, Barrett, Persimmons, Vistry. And as you can see, we've got 3 building companies. You wouldn't want them. You wouldn't want any more than 2 from the one sector. In my portfolio, I've got both Persimmons and Bellway. And we've got Cranswick, ICP. I bought a few of those the other day based on this. And that's the search. That's the search with the price less than value. You're going to find in a good market that adding that line reduces the performance a little bit. But it's a more conservative approach in that if the share is trading above the VectorVest valuation and they have a mishap, then that can be severely punished. So it's a much more less aggressive, hands-off approach. So those are 2 approaches to the worry-free investing. My approach is just that search. RV greater than 1.25 with a high RS. Susan adds in that extra line. So you need to think about where you want to be in that. Do you want to be like Susan, very, very conservative, and my word, she does well, or maybe slightly more aggressive the way I actually use it? Dr. DeLito's method of using the worry-free is essentially the same as mine. High RS, high RV, and if the general market is rising, then these shares rise with it, above their short-term valuation. So that was the performance in 2019. It was up 50% in 2019. Then, of course, I gave back 15% in the sell-off in February. So from the start of 2019, first confirmed call was on the 9th, to the sell-off in February 2020, that was up, what, let's call it 32, 33%. That's in 2019. We get stopped out of 2 shares in this period just here. That was the only 2 trades the whole year. And then, of course, in 2020, we get stopped at a whole darn lot. That's a search that I did, a test that I did when I first put this together. That's 20 years. That's 2000 to 2003. That is the global financial crisis. That's the Euro crisis. Clearly it's done this now. That's 16, stopped in 16. That's when I stopped back testing and testing forward with real money, my own money. And I'm very, very happy with the outcome. If I was a younger man, I would start up my own asset management company based on this, but I'm not a younger man. I'm 66 and I enjoy life a little bit. I'm very happy. I've tested it. North Carolina has tested it, where our head office is, and our customers, especially Mark and Guildford, has tested it, and it works. So for those of you that are VectorVest customers, this is going to be a little bit redundant. For those of you that are new, I'm going to try and show you how to put this all together. That was me trying to keep the annual reports. I failed miserably. I didn't have the skills. I'm essentially an engineer. I didn't have the time, and to tell you the God's honest truth, I didn't have the inclination. When I first started this in the 1980s, I was playing rugby in South Africa for a provincial side called Transvaal. That's why I went there. And we were playing to 65,000 every Saturday afternoon all over the country. It was a magnificent time. I played at the opening of Ellis Park and reopening of Ellis Park, should I say, against a World 15. Oh, what an afternoon. There was 82,000 people in the crowd that afternoon. So I didn't have the time for the annual reports. So I traded technically and did well. And then some years ago, I found VectorVest and tripped over it by accident that would do the fundamentals for me. And to break out, I've got a plan, as I'm sure you assumed I had. I put together this course. It's built into VectorVest. It's been professionally narrated, so you won't have to listen to me bumbling on. The first module, and there's 5 of them, is the detail of how to analyze the stock in 30 seconds. So you can separate the good from the bad. The second part is all about risk. Essentially, how and when to get rid of the bad ones. So the first part, how to sort the good from the bad, and the second part is how to get rid of the bad ones, how to optimize reward, how to minimize risk, how to size your positions properly. The third section is all about market timing and the detail of those market timing systems that I spoke about very, very briefly. So sort the good from the bad, get rid of the bad, know when it's safe to buy in again, and then module number 4 is what to buy, and some cherry picking checklists to work out and find shares that suit your objectives. And then number 5 is a plan to put it all together. And they charge a heap for that on the other side of the pond, but as you all know, we're new here. And if you roll up your sleeves, you work with me, work through it. That's £5.95. That's the link for those of you that are new. Those of you that have got VectorVest, folks, the course is on VectorVest, so you can chill. I'll show you where it is in a second. So vectorvest.co.uk/proven. And as they say on the TV, that's not all. I'm going to get 30 days access to VectorVest World. That's the US, Canada, the whole of Europe, and Australia. And ladies and gentlemen, that's worth £49 on its own. If you decide to stay with VectorVest after 30 days, then you're going to be invoiced at £49 a month. It's on a month-by-month basis, and if we can't make you money, you can stop at any time. And I do weekly webcasts. My colleague Glenn Tompkins in the States does a weekly webcast on a Thursday. I run a national user group with Susan Thornborough. And my colleague Stan in Canada runs an international user group. And all these meetings are recorded. You can play them when you get a gap. And we have a call center that's open from 12 midday to 12 at night. And that's a free call from the UK. This is a farmer. He lives in the north of Somerset, and he's finally making money. Since I got him involved with VectorVest, and he got in at last November, and this period from last November following worry-free stocks is the first time he's made any money in years. Cheers, Richard. Richard's an old customer, so he's got the thing already. Okay. So VectorVest, if you would like to work with me, vectorvest.co.uk/proven. and it's £5.95 for a 30-day trial of VectorVest, including the course. And then if you think you wish to continue, it's £49 a month. So I'll just show you where the course is, in case some of you have got VectorVest and you don't know where it is. If we go to VectorVest homepage and go to training, there it is. Now, what's also very useful, folks, is this navigation training series. And if I click on that, it opens in a different window. And, well, it should open in a different window. There we go. Come on, girl. There's a lot of stuff open on my computer with this YouTube streaming, folks. Pretty much everything you would ever want to know about VectorVest in terms of navigation is here. So, for example, we talked about Unisearch, and there's, in fact, 3 sessions on Unisearch. We have a backtester session on that. Portfolio Manager. Portfolio Manager can be, in fact, arranged so that it sends you an email when there's something to do. And, in fact, in the US, VectorVest can, in fact, be linked up to your broker. But we can't offer that in the UK because the FCA say that that would be financial advice. So those of you that are new, that's the link, vectorvest.co.uk/proven. Any questions, ladies and gentlemen? Any questions? I've kept you far too long. I was going to do it, my objective was to do it in 3/4 of an hour, and I failed miserably. Andy, no, Andy asked that I do a YouTube this week. I haven't, Andy. I've been busy doing a promotion with a website called London Southeast. So I'll do one tomorrow, Andy. Been up to my eyes. This is recorded, certainly. At least I hope it is. If I managed to remember. Yeah, it's been recorded. You should get a recording of this, Andy, later on, okay? Well, it's 8 now, so it's 3. All the admin's done in America, so it's 3 in America. You should get it today, folks. So all of you that are new, if you, in fact, sign up for our offer now, you'll get an email from us about my Monday afternoon meeting next Monday afternoon. Okay. All right, guys, and no more questions. Have a great evening. And those of you that are VectorVest customers, and I hope that's you all, I'll see you all next Monday afternoon at 1:30. I hope that the problems that we had with the emails on Monday will have been sorted out. And my utmost apologies for those. It was a bit of a mess. Gremlins. Take care, everyone. Bye-bye.